So we're back to our old reflex here. Equities are down, bonds are down. You are seeing a little bit of a drift higher in energy stocks, but oil prices are down as well. How do you invest in this environment? Let's bring in Alissa Corcoran, who is the Chief Investment Officer at Kopernik Global Investors. Alissa, in many ways, we've been here before, right? The last month was kind of the outlier of the kind of markets that we've seen so far in 2022. What do you make of, just the market's mood in the last 24 hours, especially post FOMC?
Yeah, I mean, I think a lot of investors were, nobody really knows what the Fed was going to do. And the important part for investors is to make sure that whatever happens, they're protected. And and valuation is the best way to do that. So we are value investors, we're bottom-up investors. We are going where the optimism isn't. So today, that's in commodities, that's also in emerging markets. And with commodities, particularly gold, even with the Fed rate rise, we are miles away from positive real returns. And negative real rates is good for commodities, good for gold. Money printing in general is good for scarce assets that are in demand.
And I want to pick up on that because it hasn't been, right? Inflation is in many ways, the highest it's been in decades, and yet gold is down 7 months in a row. Why hasn't that worked out?
Absolutely. And you do have to take a longer term investment horizon when you're looking at these trends. However, I think investors are making the mistake and assuming that rising rates are bad for gold. And what we even told investors a number of times during our conference calls with client meetings is that it's real rates that matter. So in the 70s, you had rates rising throughout the decade, and gold did not fall. Gold went from $35 an ounce up to $800 an ounce. It wasn't until 1980, when real rates were positive, that gold started to come back. And that's the important part. And inflation is very high and much higher than rates today. So what we like is we think that gold is going higher. You've had a huge expansion of the monetary base. But even if it doesn't, the gold miners are an incredible opportunity. I mean, gold is flat since 2011, yet the gold miners are down 60 to 80%. And so we think that, even if gold doesn't go anywhere, you still have some upside in the gold miners, and you get that free call option on a rising gold price.
So let's maybe use an example. Today we have Barrick Gold, which is not doing well for investors today, even though it beat expectations. It had some operational issues in the quarter that are leading to a lower stock price. It's down about 6% right now. Is Barrick an example of something that you like longer term? Or do you have a different set of names that you're looking at?
We used to own Barrick. We prefer Newcrest is one of our largest holdings in our global all cap fund. Both Barrick and Newcrest have very long-lived reserves. We prefer Newcrest's management team. They've invested countercyclically. Newcrest has a very strong balance sheet. They have diversified asset bases. And so we prefer Newcrest. That doesn't mean that Barrick shouldn't also do very well. I mean, Barrick has some fantastic assets, but where we are finding the most optionality to the gold price are actually in these companies such as Seabridge or Northern Dynasty, companies that have decades worth of gold, but actually aren't in production yet. Barrick has to replace a huge number of ounces every single year to keep that reserve base. Some of these mining companies that are not producing, they don't have that same pressure. So that's and the market is discounting them too extreme. These companies are priced, at very small market caps, but massive resources. We believe these companies could go up 10 times.
Oh, so that's your view within the mining complex of commodities. Within the energy component, is the trade in oil, is the trade in natural gas and other parts that are, I guess, being overshadowed by the dominant oil story?
Absolutely. We think that we're pretty much neutral on oil, but the more exciting opportunities we believe are in uranium, which is higher than it was, but it's still well below the incentive price. And same with natural gas, particularly in the U.S. Natural gas prices are here in Europe, and they're much lower in the U.S. If there's any sort of arbitrage with those pricing, the U.S. natural gas companies such as Range or Southwestern should do very well. But the majority of our energy is in uranium companies. We own Cameco, Kazatomprom, some of the smaller uranium companies, like the gold companies that are sitting on deposits but are not actually mining that uranium. They have exposure to, they have that long optionality to rising uranium prices.
And so you're looking at this kind of these long-term theses that it sounds like are in some ways impervious to what the Fed is going to do in the short term. Is that how you're trying to screen for opportunities?
We are value investors, so certainly rates are part of rates are an important part of any analysis. However, the best thing, nobody can know what they're going to do. So the best thing that you can do is, as an investor, is make sure that you are investing in companies that are priced in all sorts of negative news. Emerging markets, for example, this strong dollar has created a lot of opportunity for investors to buy world-class businesses in China and in South Korea. We own Hyundai, for example, which is a global company. It produces cars all over, sells cars all over the world. It has Tesla, for example, has 7 times the share in electric vehicles, yet it has 30 times the market cap of Hyundai. So there are a lot of opportunities for investors if they look outside of the U.S. where they're not as exposed to rising rates.
Hey, speaking of looking outside the U.S., why go all the way to South Korea when we're just north of the border from you? Many people have talked about the TSX and how cheap it is and how it's kind of a gold mine, to use a pun, for value investors like yourselves.
Well, absolutely, and we agree. I mean, Canada is our largest position in our global all-cap fund because we own so many miners. 25% of our portfolio is invested in gold miners. Then we have a further 10% in uranium, and so a lot of Canadian exposure, and the TSX would certainly capture that. But commodities in general should do very well in this environment where you've had a lot of money printing. I mean, the number of dollars has basically gone up tenfold, but the resources have stayed the same. That in dollars per resource is a very good scenario. That worked very well in the 1970s. We're in a similar environment today. You had earlier in the 1970s, you had a bear market commodities. CapEx was not coming online to supply new supply. So today, mining CapEx is down in half since 2014. You're not seeing that supply, the CapEx to make sure that supply meets demand. That's very bullish for commodity prices.